Good afternoon, good evening, morning, depending on where you're at. I'm just gonna wait a couple minutes so I can see if I can hear myself. Mm. Okay, I can hear myself now. All right. Hope you're doing well. So I will be going through the motions of reviewing today, and I'll give you a little bit of insight on hopefully some things that might help you. But before we begin, in the description box of this live stream and or video, you'll see the risk disclaimer. Everything I'm saying here is for informational purposes only. None of it's meant for you to take a trade on it with live funds. It's not meant to inspire a trade decision. It's just me simply going over things that I have found salient over the last 34 years. So there you go. The chart here I'm showing you is the micro E-mini NASDAQ 100 March contract for 2026. And let me just start off by saying I am so pleased to see so many dial back to a micro. And I was kind of hoping that this would be viewed as a way of saying, okay, well, if even ICT is going down to the micro when he's talking about concepts and commentary, that it's, you know, how can he come at me if he's doing it? And that's the influence I'm trying to impose on all of you. The risk is ridiculous right now, so it's good business for you to dial back that measure of risk. And trading a mini right now or multiple minis, unless you're extremely well capitalized and very, very well versed with experience, it's ill advised. Let's just say it that way. Okay. So we're looking at the daily chart. And as you can see, I have one annotation here. And I mentioned that this is where I think for the first quarter, first half of the year, that's where we're going to likely draw to for NASDAQ. Now, since we had our last discussion, and I'll talk about Forex real briefly too before I close this one. So we will revisit those three markets: the dollar index, the euro dollar, and the pound dollar. Okay, so if you're a Forex person, just kind of endure this, or if you're watching the replay of the video, it's an older um, participation on your part. You're not here live. Just scrub forward until you see the video change to Forex. It'll be the dollar index first. Okay. And then a lot of you don't concern yourself with the futures market, and that's unfortunate because it's the same things here that you'd be utilizing in the forex market, but it is what it is, right? So I suspect that this is where we're going to likely draw to eventually, and my mindset is really focused primarily on those trades that kind of like gravitate towards that. So for bias purposes, I'm looking for this as a draw on liquidity. Just learn how to type today. And this is the business that I'm focusing on for present, like right now. Going forward, each day, I'm looking for reasons to justify why the market may, in fact, be gravitating towards this level down here. Okay. So if we have a bias in mind, then obviously it makes good sense to try to focus on setups that would allow us to tape read or demo trade. See how I segued into that, not live trading. The idea of following price action with that narrative, it helps build continuity. It will reward you with sticking with the higher time frame premise, which is a daily chart here. And if we then flesh out the ideas from the daily chart and also remind ourselves the conditions that we're in high resistance liquidity run conditions. High liquidity run conditions are when the market stays many times in the same previous candles range. And just for clarity's sake, if you look at what we did today, today's range basically is an inside day. This is Friday's day high and day low. but just inside, I'm sorry, just outside of the low, but the body stayed inside of the previous day's range. Okay, so there's two versions of an inside day. You have an actual inside day where today's day, highest high and lowest low, is lower on the low the previous day, and the low of today does not go below the previous day. In other words, general practitioners of classic support resistance type trading, okay, they will use previous high, previous low. And if there's a day that forms where the entirety of the day's range, the highest high and the lowest low, is not beyond the previous day's range. And I'll zoom in, show you what I mean. You have this as previous day's high and previous day's low. Okay. So previous day's high and previous day's low. Today's high is lower. So we were not able to trade above previous day's range. So it fell short of previous day or Friday's daily high. Today's actual low did in fact trade below Friday's low. Look up here in the upper left-hand corner up here. Okay, upper left-hand corner. Friday's low comes in at 24,677 even. Today's low comes in at 24,667.75. So we're slightly lower. See that? Almost 10 handles lower. But here's where the curveball comes in, ICT style. This range, okay, see this range, Friday, the body of the candle for today's trading is inside Friday's range. So yes, the wicks are allowed to do the damage. It explored below Friday's low. That's fine. But it's also telling me that we are in a compression. And when the market's compression builds up over days, okay, smaller ranges, inside days, what happens is it creates a release where it's just springs ahead and goes either higher or lower. Now, right away, if you just take that sound bite out of my video and put it on your stuff, it's going to sound like, see, he's calling both sides of the marketplace. But I opened this video up where I said, I believe, and I've been kind of like pushing this and prodding this on your part for tape reading. I'm bearish on NASDAQ. I expect lower prices. Now, if we take out this high here, then I'll revisit the idea of whether or not that's right or wrong. But for right now, until this high is taken out, I'm sticking with that idea. I gave you a very specific reference point on the daily chart. Our fair value gap. Okay. So I said, watch this one here. It could trade up into that, but ultimately, we only saw one little deviation outside of this range with this close, which was a little, a little concerning from a precision stance if we weren't trading in this high resistance liquidity run condition where we're staying inside of inefficiencies longer than we should. If it was low resistance liquidity run conditions, that means we will see volume imbalances, we'll see fair value gaps, we'll see protraction, one-sided big range candles going one direction, and then any candle that goes against that underlying direction will be small bodies, and then small little retracements, short-lived retracements, and then longer protractions with larger candlesticks and the longer duration of price runs, number of candles, in other words, will be moving in one direction. Notice that we're just staying inside this range here. So we're in high resistance liquidity run conditions. That means it's not in a hurry to go anywhere. And that's typical at the beginning of the year. So by having these levels here, let me go back and make sure I made a point clear enough. Inside days are either today's high is lower than previous day's high, and today's low is higher than previous day's low. That's the classic rendition of an inside day. I will look at this view of today's price action as an inside day because of the body. The body is inside of Friday's low to high. See it? Okay. So this in and of itself is a PD array. It's a very specific perspective on me anticipating a measure of protraction, movement, something that's coming that I think is rewarding for a short term or day trader, where we will have sustained price runs in one direction. That's what I expect. So in tomorrow or Wednesday's trading, I suspect that would be a likely scenario. Now, how does that translate to what I've said so far here? I would very much like to see a expansion to the downside and explore this low here. I'm not interested in seeing prices go higher. So it's this low here, and then eventually, with this idea in mind, which is these relative equal lows, as I mentioned earlier in the year when we started discussing NASDAQ from the daily perspective. Okay. So hopefully that is very clear. It's not ambiguous. It's not complicated. If it's complicated, to say so in the comments of the X feed and show me the minute marker where you think I'm falling short of explanation, or if you need some more clarity, and I'll be glad to help you out on X. It's the interactive experience over there. And if not, I'm sure you'll see us, discussing things in Kit's live stream afterwards. The So these are the levels that I'm watching, and now because we have this wick, you see this wick right here? That's a discount wick, and it's the opposing side or discount side of the market reaching lower that we would have to consider this range here. So you would take this and grade that. And for the folks that want to know what my fib settings, okay, I unfortunately will have to do this a lot of times because there's new subscribers always come to the channel and they want to know what the settings are. So just take a screenshot of that, and that way you'll be able to address your Fibonacci the same way as mine. All right. So consequent encroachment midpoint here, I would like to see it trade down below that and close below that. If it closes below that, discount wick, generally, not all the time, generally, it's indicative of a continuation in that direction. If we fail to get below the midpoint of the wick on a closing basis, that usually indicates that we're going to stay in high resistance liquidity run conditions, and that low will not be explored, at least for right now, until consequent encroachment level is breached by a closing basis. Very simple strategy, very simple context, right? Not complicated at all. But as soon as we get a close below that, then I would expect prices to start having very long, like these big black down candles like this, big black stretched out limousines. The place to be is this low, and ultimately Club 64 down here. Everybody wants to go hopping down in there, right? That's where all the honeys are. In deference to the ladies, it's where all the hot guys are. In deference to the men, it's where all the ladies you want to take home are. So right there's one night stand city. That's where you want to get to eventually. That's how I'm looking at it. I want to see it gravitate there. Everybody wants to go there. And that's what we're looking for continuation. So there should be no question as to what I'm expecting here based on the daily chart. It's not convoluted. It's not, too many things going on. It's very, very specific things. Okay. Now, if we happen to expand to the upside and take out this high, it can do it on a wick simply because of the volatility that we're in right now. But it need not close above this. If it closes above that, then I'm absolutely going to be considering myself wrong, because it may, in fact, try to gravitate towards this high here. So that would be like the early warning sign. But it can go up here on a wick basis and then come back down. And if it does that, it needs to start respecting this fair value gap. But admittedly, I would rather it not do that at all, because we have a really nice swing high here, because we have Thursday's high there, Friday's high higher, and it also took out this little short-term high. And then today's high was lower. So a swing high is simply just 3 candles or 3 bars, with the one in the middle being the uppermost, and then 2 lower highs to the left and right of it. Okay. So it's 3 candles entirely. All right. So now we got that boring stuff out of the way. Just note that this price level right there, you want to have that. I'm not going to leave this Fibonacci on the chart. It's simply me annotating on my notepad that I want to see that 24,608 half level be breached on a closing basis. Okay, so that's what I have scribbled on my little notepad here. And then now I can remove this. It's done its work. See how easy it is? It's management of the information, management of key levels, and managing your chart, keeping it pristine. The least amount of things you have on your chart, the easier it's going to be for you to follow a narrative or developing narrative while you're doing your analysis. So now we can drop down into a 15-minute time frame. Just get a lay of the land because it's a bellwether chart time frame. Okay. And today is Monday, so this right there is midnight. So we rallied back up into this inefficiency here. New week opening gap. Couldn't even get to it there, so we'll just annotate that just for the sake of completeness. I don't want to spend too much time on this because I could really just belabor the situation and try to drag you across a whole lot of talking. It's not necessary. But this is the new week opening gap. Notice the run this morning, which we will get into that. Okay, if you saw Cameron's trade, I will review the things I was kind of like tapping him and saying, hey, look, pay attention to this. And I'll show you the setup and the signal and whatnot, and the other places that you could have taken a trade, okay, or where I would have taken a trade in deference to where he did his. So new week opening gap, we rallied up this morning at 9:30. We couldn't get there, failed, but we did take out buy side here. This inefficiency right there, we have a change in the state of delivery with this order block opening price there. You see how we revisited that? Hit it, hammered it, laid over top of this it's not a suspension block, SIBI with a volume imbalance on a low. So that's this low to that candlestick's open right there. Okay. And that is not going to stay orange because that implies inversion, and it's not an inversion. PD array. It's simply just using it as a premium SIBI with buy side running up into that. And I'll give you some tips on SMT today as well. It's a smorgasbord here, folks. All for free. I'm such a guy. What a guy, ICT. So we have buy side taken, tagged, and then we have sell side here, and then sell side here. So we'll map that out. Now, obviously, you saw that Cameron only took one trade today, and I had prompted him to focus on shorts. It was me saying, look, don't chase any rallies. Let's focus on being short. Focus on these levels that we're looking at here. So these are all the commentary that you don't have access to when I'm talking to him. And so if he's sitting next to me, I'm saying, okay, this is what we're doing pre-market. We're looking at these levels. We're looking at the potential of these levels being drawn to. So it's this, and then it's this as well. Okay, and we're going to ring in the ES as well. So just bear with me for a little minute. So we have sell side here and sell side there. Changing the state of delivery, new week opening gap. So what we do is we anticipate the likelihood of the market wanting to gravitate to, at the very minimum, this buy side, because 9:30 opening bell and opening range, which is 30 minutes. I don't care what anybody else says. Okay. That's the actual opening range algorithmically. And it will protract to take buy side, close proximity buy side, close proximity sell side. And then the real move will ensue. So think about what I've already said so far and what I've said in previous live streams and commentary on my YouTube channel this year. I'm bearish on NASDAQ. Okay, I'm looking for lower prices. So I'm going to have a greater affinity or desire to see short setups than that of long setups. That's not to disparage anyone to tape read or try to explore PD arrays that are discounts and practice doing them. I'm just saying that if we're going to be forced to say, okay, I want to try to trade with the most things in my favor or the most advantages, to say it that way, I'm going to stick to a higher time frame bias or premise because of the volatility being what it is. I want to be highly selective in my setups, and I'm trying to convey that to my children so that way they are going to adopt that mindset too, and not just go in there and say, well, we have all these tools. Let me just get in here and spray the market with buys and sells all day long and just scalp, go crazy, because you won't catch the big runs which I'm hopefully getting Cameron acclimated to seeing that he's getting on side. That means he's on the right direction, but don't sell himself short on just the easiest low hanging fruit objective. Leave something on for a daily range because we will eventually be migrating to those conditions as we get closer to the springtime months, those being April, the last couple weeks of March, April, and May. Okay. So with this idea here, we can now flesh out a lower time frame. We'll go down in 1 minute, and you're going to see a whole lot more lines. Okay, and these lines will be the same lines I covered this morning on a very short video I posted on my X or Twitter feed. It was the surveying the lay of the land. Okay, so these levels over here, that orange box up there is the new week opening gap, and honestly, it shouldn't be that color. I apologize. So we'll just do this. We'll make it a dark gray. Okay, so that's new week opening gap. The previous settlement here, this candlestick's close. So right up here, that candlestick's close, 25,079 even. That's today's regular trading hours opening range gap high. The low, because while we were watching price action, it's going to open up down here. And as you can see, it does that very thing at 9:30 on this candlestick right here. That opening price, that's this one right here, folks, upper left. That opening price is 24,981 and a quarter. Okay. And that's what's highlighted here. So because that's lower than where we settled at last Friday on regular trading hours, remember, look in the lower right hand corner. That's regular trading hours. You're going to see the disparity between where regular trading hours begin at 9:30 Eastern time versus where we stop trading on regular trading hours previous session or previous day. In this case, it's previous week because it's Monday and last trading day would have been viewed through regular trading hours on Friday, and it closes at 4:14 p.m. as you can see at the bottom of the chart at the time axis, okay? So with that, we have several things here. We have several things. We have the idea of reaching for the new week opening gap. We have the idea of reaching for buy side liquidity because that's the Judas swing, that's the manipulation, that's the fake out move, that's the trick, the trap. It's the enticement to induce buyers to come into the market with it's heavily handed for lower prices. Okay, so in other words, smart money is engineering buy side liquidity to be rated. They absorb that buy side liquidity to be counterparty to it and sell short with the vested interest of seeing it trade to lower price lows where existing buy stops would be resting so they can buy at a lower price. So now because we have these levels here and we're going to grade the regular trading hours, opening range gap, make sure it's on the right price, Michael. I have to be conscious of how much time I'm spending because I have to make sure the videos are under an hour so that way it does that automatic AI translation. Which I wish they would get better actors for my voice because it don't sound like anything like that at all. So let's go down into the lower, I'm sorry, the electronic trading hours. Okay, and here we are at the first few minutes of trading. And all the levels I've covered here, if you're confused at this point, just rewind the video, rewind it. Don't do it right now while you're watching the live stream. Okay. I promise it's all going to be left on the YouTube channel. But while we're watching, just know that every level I've just covered is here in the chart now. Okay. Those that are annotated with like Thursday's regular trading hours opening range gap high, Thursday's regular trading hours opening range gap low, those levels are the same procedure that you watched me just do today for Monday's trading. So how we came to Monday's regular trading hours opening range gap high and Monday's regular trading hours opening range gap low, wherever the price is at 9:30 Eastern time relative to where we closed on the previous trading day in regular trading hours at 4:14 p.m. Eastern time, if where we're about to open up is above the previous day's 4:14 p.m. Eastern time, if it's above it, then we're opening with a premium gap, and that means 9:30's opening is going to be the regular trading hours opening range gap high. But a couple minutes before 9:30, excuse me, if price is below previous day's regular trading hours close at 4:14 p.m. Eastern time, then we're opening with a discount gap. That means 9:30's opening price will be regular trading hours opening range gap low. Okay? If if you play that part over a couple different times and write it out as I said it, it's perfectly understood and you'll be able to see it by going back through your data and annotating your chart that way. Okay? So we have at 9:30, the market opens up and it's attacking buy side liquidity, which are these relative equal highs. And then we have that change in the state of delivery on the 15-minute time frame. That's this pink line right here. It trades up into that. You see that? So what are we doing here? We're getting a higher time frame premise. I'm giving you an entire complete trading model today, in case you haven't noticed that. We're going from a daily chart, and we're trying to get a feel for where it's likely to draw to. Where is it likely to draw to? Not just for today, but on a longer scale price run. What is it likely to go to? Where is it drawing to? Don't be afraid of being wrong on that daily chart. There's going to be lots of daily candles that go against this idea. And traders that are brand new or students that are brand new to this idea, they get their, emotions all whacked out because they have a day that just screams against that and they think, oh no, I better change my bias. I better change the way I'm looking at this. I'm probably wrong. And by constantly referring back to the daily chart, it'll keep you in focus so that way you're not going back and forth intraday, buying and selling, and second guessing your higher time frame premise. Okay, so my bias is bearish on NASDAQ. My premise is it's likely to start seeking lower prices now because we have an inside day on the body basis. Today's body of the daily candle is inside of Friday's range. So I'm expecting tomorrow or Wednesday's volatility to start showing one-sidedness in big down black closed candles. That's what I'm looking for my chart. Now, whether or not that happens, remains to be seen. But that's what I teach my kids. That's what I've been doing for 34 years. I'm trying to promote that idea as a student, to study price action with that view in mind. Okay. So changing the state of delivery, we watch and see because it could go up into that gray box. Why? Because Monday's regular trading hours opening range gap is last Friday's 4:14 p.m. Eastern Standard Time regular trading hours closing price. That's what that price is up there at 25,079 even. That gray box is new week opening gap. So there's two things that could lead to this gravitating towards that going up there. Okay. So now the question is, you watched Cameron trade, and now I'm going to explain what I would have done if I were doing the actual trading and not sitting with him and it was just me isolated solo, just doing my normal thing. I would do this. The buy side's here. It runs above that. As soon as we hit the change in the state of delivery, I'm looking at this up close price. That's rejection block. I'm going to wait for that to trade below it like we do here. And as soon as we get that here, I'm hitting that, and my stop loss is going to be mid new week opening gap. One contract. One, not six, like you see me do on my standard run. Just one contract. And then I would look to build another entry in it. Here we have 9:30 opening. So that's the opening price at 9:30, which also is, in this case, Monday's regular trading hours opening range gap low, because 9:30's opening price is lower than that last Friday, 4:14 p.m. Eastern times closing price on regular trading hours. That means you're going to have to toggle that chart, which is not showing that now. It's electronic trading hours here. So you would toggle it to regular trading hours. We've done that so far in this live stream. So we don't need to do that now. The charts have been annotated. So all these levels here is what's on my notepad. You're all asking for what's on your notepad. Show us your notepad. This is what I'm putting on here. There's nothing secret on here. I promise you. Nothing except for this stuff. So once we started to drop off, it could still run that high. And as we're seeing it run up here, watch what happens. This high here with ES. So we go with EMES H2026. What do you see different here? NASDAQ had a lower high. See that? ES was pushing higher. It was pumping it higher, higher, higher. So this is SMT. So for your notes, when is there a high probability for efficiency using SMT related correlated asset analysis? In other words, you're looking at ES versus NASDAQ. When is that appropriate? When am I even considering it? When there is a liquidity run or a high volatility injection like news. Okay. 9:30 is always going to act like that. 9:30 is running liquidity. The first few minutes, first 30 minutes, we're looking for liquidity for it to gravitate towards. In this case, we're seeing that Judas swing higher at 9:30. Here's 9:30's candle. It rallies up and it makes a high, higher high, higher high. Bull flag traders are going to look at that and fall in love. That's my Valentine. Kissy, kissy. But this is the kiss of death because we're going to go back to the NASDAQ and see how it made a lower high here. So now, when do I use stop orders to get into a trade? Or when do I mark it in when I'm watching price action trade to and through a specific level? In this case, Cameron was prompted to watch that candlestick's opening price right there. When price was rallying up like that, I told him, I said, as soon as you see it trade through that opening price, as soon as you see it, enter at the market, sell your 2 contracts of micro. He put his little clicker on. You've seen him click on it, okay? And just so you know, notice how I keep my chart centered. I'm very, very OCD about it, okay? And it was driving me nuts, but I couldn't tell him to fix his chart, and I didn't want to touch the mouse. But as soon as he put the order in, I said, "Now it's going to drop a little bit. Give it a chance to drop, and then you're going to put your stop loss just below the opening price because if it's going to run, it's going to rip through it real quick." And you can see him, he's hovering over top of the close button. He's indecisive. He don't know what he's wanting to do. And he's like, okay, when do I do it now, dad? And because he's used to fair value gaps. So now what I'm teaching him is sharp reversal patterns. And this is what we're covering today. Okay, so the topic today is sharp reversal patterns and using stop orders or market orders, not limit orders. So when am I doing that? Here we're seeing an SMT divergence. We have the change in state of delivery traded to on the NASDAQ. This high here, I'm going to see it fail. I don't need to get up here and short it. I don't need to do that. But I would have already been short on this candlestick right there with a stop loss at mid new week opening gap. If I would have got stopped out, no problem. I would have been waiting for another setup to see it break down and look for some kind of a fair value gap, some kind of institutional order flow entry drill, something to that effect, a bearish breaker. I would have looked for it to then also present a SMT divergence up here. If you're looking for SMT and it's not occurring, or if you're not looking at it at a time when liquidity is being taken, with the express interest of it likely going another direction, opposite direction. Or if you're not using it at the opening range, the first 30 minutes, you're probably looking for SMT in the most inopportune times. SMT is wonderful, folks. It's a wonderful idea and concept, but there's a place for it, and it's not in every setup. So if you want to use SMT, smart money tool, smart money technique, okay, I never really settled on what the T stands for. It's just the divergence between closely correlated pairs or assets. So if it's Forex, the same thing there. It's liquidity or opening ranges. Here, as it dropped down through it, you can watch the recording I posted on X where he put his little sell order in for his 2 micro contracts because his account has not had the withdrawal taken because he had to send them a bank statement. So you have to send the bank statement in, wait for them to approve it, and then you do the bank wire. And the process of doing that today, he said, let's just see if we can add a little bit more to it. And that's what he did today. So there you go. So now he's just underneath 13,000. So it's yeah, just like a couple dollars below 13,000. So basically almost 30% return in 2 weeks of trading, micros, and 3 grand. So that's real money. Now, what does that mean for you? Nothing. Should it inspire you? No, because anybody's trading shouldn't be used to inspire you. The conceptual ideas I'm teaching here, that's what you should be inspired by, because this is the stuff he's learning how to do. And he's doing it with a real account, not demo. Told you, real money this year. We're not trying to, you know, pull your leg anymore. We're not trying to keep you in demo mindset. Just focus on starting very, very humbly and going forward and just using concepts with low leverage, and you'll be able to hold on to the setups. And he's learning right in front of you. So you're getting like a test tube environment watching my actual son. So it breaks below that price, and look at the excitement lower. Boom, lots of animation. And where did it run quickly for? Those stops right here. That's exactly what you want to see. You want to see that. Now, when that occurs, do we want to see this entire gap here fill in and do any kind of patchwork over that? No. We want to see a small portion of that left open. So I'm not sure if I got that. Yeah, there we go. So this gap here, there's consequent encroachment of it, and we can grade that also. Now watch, this is the purpose of having all those levels on your Fibonacci. Okay, this is going to be worth the price of the admission today. The bodies, notice that they cannot even get back to consequent encroachment, which is the midpoint, 0.5 level. The wicks are allowed to do the damage, but it went through consequent encroachment. It went through the 0.625 level, but it could not get to the upper quadrant 0.75 level. You see that? Failed to get there. But then reversed and the bodies were below mid-level, consequent encroachment. That right there indicates weakness. It doesn't mean get short with an ultra short little tiny stop loss, because the volatility right now is exorbitant. It means expect it to eventually work its way lower. Here we have another attempt to get up into it, but now look what this does. It doesn't even get to consequent encroachment at all. Now we have a lower high in deference to this high inside of this inefficiency. No bodies of the candles are allowed to be laid down in the upper half. That's real institutional order flow. You don't need level 2 data. You don't need level 3 data. You don't need whatever else you want to call that stuff out there. Nothing. You don't need any of that stuff. Footprint, none of that. You don't need it. Volume profile, you don't need none of that. Okay? I promise you, it's as simple as open, high, low, and close in time. That's all you need. And that's not complicated. None of the things I'm showing here is a new twist on anything. I'm just giving you a refresher. And what I was kind of like pressing on my son this morning, to focus on this, focus on this. So this drop down here, notice these relative equal lows here. I told him be mindful of that. It's up to him if he wants to close his trade below this or hold for these relative equal lows, which is what you've seen in this chart annotated. So these relative equal lows is sell side, and then you have these as well. So as price dropped down here, his excitement was like, I don't want to give it up. I have a good win. And that's okay. You're managing the trade. You'll learn either way. If it goes down and hits the lower sell side, you'll have an experience. If it doesn't and you lower your stop and it stops you out, you'll have experience doing that too. But whatever you feel inclined to do, just do it. Don't think about it. As soon as you feel it, do it, because that's the only way you're going to get a baseline on evaluating what your emotional and psychological impact of your actions are. You can't hide from them. You have to be honest in your journal, and you can't lie to me because I'm watching you do it. So you saw what he did. He lowered his stop down, and it came back and stopped him out, but then ultimately went down to the lower relative equal lows, which are these over here. Okay. So obviously, when that happens and you're new and you're thinking, well, I could have made $400, Dad, and or if you're saying it to yourself, I could have made $400 and I only made $304. So I wish I would have stayed in there and made the extra 115 or $111 more. I wish I would have done that. Don't do those things. Don't dwell on that stuff. Look at what you did right And then where are the opportunities that you could have done things differently? You're not armchair quarterbacking yourself and beating yourself up and saying, this is what you did wrong. Highlight what you did right, congratulate yourself, encourage yourself that you did this and it feels good that I've done that. And then saying, now these are things I could have done, but I didn't notice it at the time, and or I don't have the experience yet to navigate it like that. But this is a wonderful experiment for me to now use for experience to move forward in my next opportunity using this information. You see how that completely disarms you? It doesn't give you any reason to feel emotional about it. You're not priding yourself and building yourself up with ego, but you're also not tearing yourself down for not having done it perfectly. And that's how you use a journal effectively. I watched a guy who supposedly is an ICT student. He says he gets out there, and I think it was last week or sometime, in the post. I'm paraphrasing now, mind you. I think the stupidest thing I wasted time on was journaling. It doesn't do anything for you. Don't do it. Okay. I promise you, this person's going to want to go right back to that because what that is, that's King Kong feeling because he's finding a little bit of consistency right now, and he's thinking, well, I wasted all that time, not realizing what he did got into the position he's at right now. Like, how can you say I wasted all that time, but you're doing okay now, and you're going to tell other people not to do it? Don't listen to people that say that stuff. I promise you, don't do that. Because if you're not keeping record of your development, if you're not logging that, if you're not measuring that, how do you know if you're really getting better? Or if you're just feeling a high when you're doing it good, and when you do it wrong, you're beating yourself up. But if you have journal entries showcasing what you're actually doing and how you're perceiving price over a long set of time, that's the only way you're going to get a baseline for evaluating whether or not you're progressing or not. It's not the outcome of the trades, folks. That is not the report card. The report card is what are you journaling and keeping in reference to for conceptual ideas that you're employing, that you're not deviating from, you're sticking to a model. That's the report card. Are you sticking to your model? Do you have a model? And a lot of these jokers out there that talk all that smack on social media because they want to seem cool. They want to seem like they're dialed in, they're locked in. They're just trying to get you hyped up so that way you follow them and get engagement. I'm trying to talk to you with the smallest of degree of leverage. And I'm trying to show you that you don't need a lot. Did you make $3,000 in the last 2 weeks at your job? Did you do that with a total of less than 1 hour's time invested? Chances are you probably didn't. And my 21-year-old has done that. He feels that in his own hands. He's done that. Okay. Now, is he getting help from dad with coaching like today? Sure. Who's going to say anything bad about that? But he's pushing the button. He's moving his stop loss. He's fluttering around trying to figure out when he should move it. He's learning. He's developing. So give yourself that freedom to be able to do that as well. So, I mean, I'm going too far on like it's a X space, right? No, no, no. Keep going. Keep going. I got to be under an hour. So it failed to make a close with the body above consequent encroachment. It failed to touch the consequent encroachment there. So we have a lower high. So now we would anticipate what? More protractions to the downside. We have sell side now that was engineered here. And then we have last Friday's regular trading hours opening range gap high, last Thursday's regular trading hours opening range gap low, Tuesday's regular trading hours opening range gap high. Look how it used it right there. Went below it, came out, hit it perfectly. What's that price right here? 24,799 half. What's this candle? You're going to look at this price right here, upper left. What's that candlestick's high? To the tick, baby. Oh, they don't use this stuff. Once the gap's closed, we all know about those gaps, ICT. Come on, you're not teaching anything. You didn't invent the gap, Kai. I'm the only one that's telling you how to use it with technical science. So it hits it here perfectly. Bang, hammers it. What time, baby? You waking up now? You falling asleep? What time did it hit that? During a macro time. Ooh, they don't exist, right? So it trades down into some old random levels, but it leaves Tuesday's regular trading hours opening range gap low. It leaves that intact. And then we pull off of that, come back down, touch Friday's regular trading hours opening range gap low. So do you see what I got here? I have a couple days worth, a week's worth of the opening range gap levels. That's the stuff I have with new day opening gaps and the consequent encroachment levels of them, if they're wide, and new week opening gaps and their gradient levels. That's all I have. And maybe once in a while I'll have a previous day's high or low. if it's really significant to me, and I grab it from the daily chart. And I just simply scribble down, what I think is going to be the draw right now for this hour and for the next hour and for the next hour. And then I keep record of how correct I am. And it tells me if I'm on side or not, if I'm in sync with the marketplace. And it's a good little drill for yourself to practice doing that each day, not even demo trading. Don't even press a button. Just follow price action and have a expectation that you're developing predictable characteristics of trading. And anybody says your job is not to predict price, you need to stop listening to that person immediately because we're not reacting. Okay. We're not. You are anticipating. A predator anticipates when the prey gets in striking distance, it needs to eat. A lion is not, well, let me react if something just walks in front of me. There's a little meme that is on social media where this little warthog just runs right by these lions. They're all just chilling. They're in the shade. And this little warthog runs by, blah, 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 blah. And they're like, "What is that?" Not one of them got up and chased it. Why? Because they weren't anticipating it. They're not hunting. So that guy, well, it just walked right on by. No problem. But if they were hunting and that thing got in close proximity to them, it would have been bacon. Goodbye. See you later, pork chops. So, as a trader, we're anticipating, we're looking for it. We want to see the gazelle get down by the watering hole and then it start to run. And we want to see if it's a pack of them, which one's the slowest one because we want low hanging fruit. We don't want to work too hard to eat. So that's what we're looking for. What does that mean? The closest target that makes sense. So if my targets are 37 and a half handles, what did he do today? He used that model with 2 micros because he had enough money to do so. You see how everything fits together? It's using a model, not throwing something in the wind and coming back and saying, "Here's my win for today," and here, 12 laptops. It's nonsense, right? So the market pulls off of that, again, comes right back down, hits the 24,677 level, trades back up to Tuesday's regular trading hours, opening range gap high, gravitates around that, then uses Tuesday's regular trading hours, opening range gap high, again, hits that, sells off, and in between these levels is no man's land. So any PD array that's not laying on top of one of these levels, I'm not really jacked about. Like I could care too less. I don't care less about it really. There has to be a key level for the PD array to be salient to me. Just simply because there's an order block that you think is an up close candle or down close candle. I see so many live streamers, so many educators, so many people out there that are so hopped up on wanting to be cool looking or informed. They look at every single candlestick and they call them incorrectly. And to me, I could be a jerk. I mean, I could go in all your comment sections and sound pompous and arrogant and look like I'm mean spirited. But I don't want to do that because it just looks like I'm trying to get your followers. I don't care about your followers because ultimately they're my followers. Okay, they're learning stuff that I authored, and you're just playing substitute teacher. So you'll learn if you've been doing it long enough or do it long enough. You'll learn that what you're doing is wrong. Okay, and I'm teaching like this. I'm teaching how to find the right PD raise. There has to be a key level at the right time. Key level, time, your PD arrays will work all the time. All the time, 100% strike right, boom, there it is. Okay. So stop asking me why I'm choosing PD arrays like this and that. Why am I using that fair value gap? Because it's right over top of a gradient level at the right time in deference to where I think the market's going to draw. If you have those three ingredients, you're going to have blue ribbon recipe results. It's going to come out beautiful, piping hot and fresh. So the market comes and meanders around in here, rallies up once more, uses Friday's regular trading hours opening range gap low, propels it once more. Look at that immediate rebalance. I love that. As soon as that candlestick opened up like that and it traded down, hammered that like that, that is one of the easiest. Get in there and go and just reach for some measure of premium. Or if it's simply a small range like 20 handles, 15 handles, 30 handles, you don't even need a liquidity pool for that. Just that's your cookie cutter. If I can get 20 handles of that, boom, done. Rip and run. And there's where we're at here. So this is all simply this meandering around between two key levels. So even if you saw like this little thing here, like would you consider that a fair value gap to trade? No. Why? There's no level there. Just simply because there's a separation between 3 candles and one in the middle has an imbalance or what would be conceived as a, or not conceived, but perceived as a imbalance, doesn't mean anything to me. It's just a common gap. But it's an extraordinarily important gap if it's laying over top of a gradient level, if it's laying over top of a opening range level. Okay, so notice that we're using very specific price levels. They're not willy-nilly levels. They're not going to hide these from you. They can't, they're not changing the level. It's, this is what everybody would see. If you do what I'm teaching here, you're all going to have the same exact to the tick price level. That's why futures is a gentleman's market, not Forex, because everybody's going to have a slightly different tick price because you're trading in their liquidity pool. But if you want to trade professionally and you want to really use money, big money, and you want precision, you're going to trade a futures market. You're going to do that. You're going to evolve and mature into trading a futures market because that's where the professionals trade. So we talked about SMT, when it's useful and all that business, and what I would have done differently. Going back now, real quick, and then I'm going to give you my short opinions on dollar index, euro, and pound, and then I'll end this stream, and then we'll hang out together with Kit's uh, trader roundup. So we have this inefficiency here. What time of day is that? It's at 9:40. So that's your very, very first presented fair value gap during the opening range, first 30 minutes. Technically, it's 29 because you want to use minute 31, as I teach my son Caleb. And the reason why, because there's very specific things that you want to use the 9:30 candle if it creates a fair value gap. I don't want to talk too much about it because there's so many things that could go wrong in the hands of someone that doesn't fully know what they're doing. So the rules are better served by following 9:31 to 10 o'clock in the morning Eastern time. The very first presented fair value gap that shows displacement, I think everybody would agree that this is displacement. This candlestick's low right there. That's the high of the fair value gap. And this candlestick's open comes in at 92, I'm sorry, 24,928 quarter. And the close here comes in at 928 3/4. So it's a half a handle or 2 ticks lower on the open on this. So that's the volume imbalance right there. So if I show it to you like this, you'll see. See the separation? See it right there? This candlestick's closed, this candlestick's open. So that's a small little volume imbalance. So that's why I draw it down to that. Okay. And that'll give you more specific price levels. So that way you can know more than Einstein. So trading up into this here, you can be a short seller as it hits consequent encroachment, and your stop loss would be 1 tick above this candlestick's low. If it stops you out, wait for it to trade back below consequent encroachment. Any run back up, that's a fair value gap or trades into this up close candle here, that would be rejection block. You could be short there. So you could have used that. So in other words, say you went short here using first presented fair value gap and went up here and stopped you out. No problem. No problem. You're not going to win every one of them. As soon as it went down below like it does here, that price right there, you would use that as your entry. That's your rejection block because it should not trade above this here and go above consequent encroachment if it is in fact weak. And there you go. You'd have an example here. Look at this wick. See that wick right there? What is it trading up to? Can you tell I missed you? Can you tell I missed talking to you? Here's consequent encroachment, 24,938 half. Doesn't even touch it 2 times. And then the candlestick goes down below the opening price there. What's the next candle going to do? Protraction. It's going to run. It opens, small little Judas swing, dumps. Where does it go to? Sell side. This is high frequency trading right there. That kind of stuff. Just like this is here. Change this day delivery, hits it, runs down. This candlestick trades below here, outside the body, the opening. So now markets has shifted, internals are shifted, bearish. Consequent encroachment of this wick here. Anything short above this candlestick's close with a stop just above consequent correction there is a nice sell, a short. Low hanging fruit, low hanging fruit, and then the actual levels at Thursday, regular trading hours, opening range gap low. I want you to have these levels on your chart. Okay. Sometime this evening, sometime before tomorrow's trading, go back through price action and look at how many times price gives you very, very sweet little price runs that are just cookie cutters. They're just nice little runs. But the main thing is look at how the protraction of the candlesticks and the magnitude of the move is on the down close candles. All of these little retracements, okay, how long are they in duration candle wise? One, two, three, couple of them, right? But when you start seeing the length and degree of how much price moves down, the bigger candles are on the downside. There's more candles going down than there are up. So order flow is what? Bearish. So you're blending two different things here. Where it is respecting and negating going in the upper half if it's bearish, or not if you're bullish, if it doesn't go down the lower half of the discount end of a PD, right? Inefficiency or an order block, something to that effect. We're looking at that characteristic of price action. And you see that with open, high, low, and close. It's a very simple procedure. So here's 6 o'clock opening. Run back into Tuesday's regular trading hours, opening range gap high. Look how smooth that is. So the initial run around in here for, the first 30 minutes or so, it might be just squirrely and just, work around where there's nothing to do. All right, so quickly, let's go over to daily chart again, and we'll look at dollar index. I'm probably over time. I'm sorry if I did. We had this portion of the inefficiency. I said that we may want to revisit that. Ultimately, I'm bearish on dollar. I said I would like to see it make a rotation go lower. As soon as I said that, it came back up and took out this high and worked in the remaining portion of this. And I told you I'm trying to get in sync with dollar index. I'm trying to get in sync with the currency pairs because I have not spent any time with them for over half a year. So none of this has indicated anything that's bullish to me. None of it's indicated that it's immediately bearish either. So I'm still getting a feel for what it's likely to do. I still am committed to the idea that I think that the dollar will likely trade at this low. But again, if I am corrected, I'll tell you. And I'll tell you what makes me feel like I'm wrong in that analysis. But I still think that this is more viable because there's nothing bullish right now for the dollar index. So going to the euro dollar, I told you we'd be quick about this. Euro dollar, I said that I'd like to see it, move higher and try to get above buy side and see if it can challenge that high. As soon as I said that, it traded lower, went into this sell side liquidity pool. Nothing in here that indicates to me that it wants to go lower, and nothing indicates that it wants to go higher. So I'm still in that discovery where I don't know exactly where I would take a trade at using the idea that I'm looking at right now. So I'm in that very soft gray area where I don't need to be right, and I'm looking for intel. I'm looking for insight to give me more information about whether or not I want to take a trade. I'm going in with the idea, with a narrative initially. Does this give me any evidence that it wants to go higher? And it's not. And it's not giving me any evidence yet that it wants to go lower either. I'm not convinced either way. And the same thing we'll find it is for pound dollar. A lot of times you guys are in a rush to just get in there and start trading every day. And I'm not. 3 decades plus has taught me that every day isn't always the best time to be in the market. There's certainly conditions like we're in right now where it's better to be highly selective and cherry pick the days that you're going to engage. That's the only cherry picking I do. Okay. So again, sell side here, I gave you guys an idea that I would have liked to seen it trade and make a run back for this high. So this would have been just an initial run, pull back into the range, and then go higher. That's kind of like what I'm aiming for. We've done pretty much that here. I'm not convinced that it's going to move higher here. I'm not convinced it's going to move lower here. I'm still waiting for more information to justify whether or not that high is intact or if it's going to be challenged. Okay, so in my opinion, I want to see if it can challenge that high because my expectation on dollar is it's going to get weak, but I may be wrong. And because I'm not taking any trades yet, I don't have a hard bias. So this is how I go into the market like after holidays or if I go on vacation, this is what I do. I look at the market and I get a feel for what it is I think it may happen. And then I stick to a procedure of following what does the price do? Is it showing me anything? Nothing here. I don't miss, like, I didn't look at this and say, oh, I wish I would have shorted that. Nothing. Like, I don't feel bad. I don't feel any kind of losing face because I said I'd like to see. Because if you go back and listen to it, I want to see if there's any evidence that the market wants to go higher. Now, a troll or somebody that's just, just a fool will say, "See, look at it, he was wrong." Yeah, that's fine. Entertain yourself if that's what you're wanting to do. But I'm trying to teach you the very concepts that I employ when I'm away from the marketplace or I have not been in front of the charts for a while. If it's some like an asset class like Forex, which I've not been doing for like at least 6 months, I haven't even considered looking at the charts. So, in terms of taking a trade, and you guys can come to your own conclusions about whether or not that's useful information or not. But this is what I do. And should the forex market and the dollar index start showing me something that is more conducive for taking a trade setup, then we'll start tapering it on a more day by day basis. But until I get a feel for what it wants to do, it's going to be once or twice a week. Okay. So I owed you one for last Thursday. That's this one today. We'll revisit again tomorrow just to stay on the schedule Tuesday and Thursdays. And that, my friends, is going to be it. I will close this one now. Hopefully, I didn't go over an hour. I don't know if I did or not, but if I did, I apologize because it won't create those automatic AI, voiceovers where it's doing it in your language. And until I talk to you next time, be safe.